This is the current federal tax developments for the week of February the 23rd, 2026. Current federal tax developments are brought to you by your state society of CPAs. I'm Ed Zollars, and again, broadcasting this week from here in Phoenix. We're going to talk about some of the things that went on this week in federal taxes. We'll begin with the massive Supreme Court decision that came right at the end of the week regarding executive tariff authority under the IEEPA. Next, we'll cover the new interim guidance for the 100% special depreciation allowance under OBBBA for qualified, basically production facilities. That's under 168N. We'll then take a look at IRS adjustments to the corporate alternative minimum tax. Again, probably most of you aren't in CAMT, but if you are into that, obviously this is some more significant guidance. After that, we're going to look at a critical circuit court split involving third-party fraud, the statute of limitations, and a request that the U.S. Supreme Court now take up the matter. And finally, we will review a recent tax court memorandum decision on valuations and penalties in a syndicated conservation easement. And this one, I believe, sets a record among those we have looked at for the largest difference in value of the property between the date it was purchased and 1 year later when the conservation easement was donated. That might tell you that it didn't likely work out well for the taxpayer in the case in question, which, yeah, it didn't. These have been working out well generally in the tax court for taxpayers. So we'll go to this. Well, it's not often that a Supreme Court decision on a tax matter suddenly becomes a huge issue everywhere, but this one got a lot of coverage on Friday. This is the case of Learning Resources, Inc. versus Trump and Trump versus VOS Selections, Inc., a pair of cases that were the appeals of which were heard by the U.S. Supreme Court. These are case numbers 24-1287 and 25-250. The Supreme Court issued their decision on Friday, February the 20th, 2026. And you probably heard about this decision if you've read any news since midday on Friday. We'll put it that way. So the basic citation here, again, we talked about, Learning Resources and the VOS Selections case is what we'll talk about. And this talks about the International Emergency Economic Powers Act, which is found in the U.S. Code in essentially Title 50 of the U.S. Code, Section 1701 and following. Now, background for this case: to deal with what he determined to be national emergencies regarding an influx of illegal drugs and persistent trade deficits, President Trump invoked his authority under the IEEPA and imposed tariffs. Under this declared emergency, the president imposed extensive tariffs, and expensive ones too, as it goes, including a 25% duty on most Canadian and Mexican imports and reciprocal tariffs on Chinese imports that were eventually raised to 145%. Now, the taxpayers sued in this case, arguing that IEEPA did not grant this authority to the president. The Federal Circuit ultimately agreed with the taxpayers, affirming that IEEPA's statutory grant allows the president to regulate importation, did not authorize these unprecedented and unbounded tariffs. The Supreme Court granted certiorari to resolve this dispute over the matter in question, and so we're now before the U.S. Supreme Court. Chief Justice Roberts actually authored the main report, right? And he grounded the majority's opinion on the fundamental separations of powers, right, when he held for the taxpayers. Article 1, Section 2. You have to remember that Article 1, Section 8, I should say, of the U.S. Supreme Court, U.S. Constitution, I should say, grants Congress the exclusive power to lay and collect taxes, duties, imposts, and excises, right? And according to the report, according to basically the opinion, the majority opinion, the framers uniquely vested this taxing power within the legislative branch, explicitly denying the executive branch any inherent peacetime authority to impose tariffs. And the government actually conceded that the president lacks inherent peacetime authority to levy tariffs. Consequently, their entire defense was built on a sweeping statutory interpretation, arguing that Congress delegated this massive taxing power to the executive branch through IEEPA's allowance to regulate importation, that the regulation of importation includes imposing tariffs. Now, the court, and there's a lot of splits on this, but The court, in the main opinion, heavily relied on their major questions doctrine to strike down the tariffs. Now, I need to say, this is one of those pieced together opinions where you have concurrences that agree in result but not in reasoning. And the major questions doctrine is one of the areas where some of those who basically ruled with the same result differ their opinion. So arguably, it's a majority opinion, which it is, but it's also a majority opinion that doesn't really have, 6 justices, because it was 6-3 opinion, that are saying that, in fact, the major questions doctrine applies to this. In fact, if anything, there is a minority that believe that the major questions doctrine ultimately gives us this answer. Certainly, a few don't believe the major questions doctrine to begin with. And then at least one indicated that the major questions doctrine should never be applied to foreign affairs. And that was actually one dissent. So it's there and it's important, but it didn't get there. But in the opinion, Chief Justice Roberts stated the court is reluctant to read into ambiguous statutory text extraordinary delegation of Congress's core powers, like the power of the purse. Because importing tariffs carries profound economic and political significance, the executive branch was required to point to clear congressional authorization for the tariffs that were imposed. Now, the government's argument that an exception to this doctrine should exist for emergency statuses or foreign affairs was explicitly rejected by the majority. Turning to the text of IEEPA under Title 50, United States Code, Section 1702A1B, the court pointed out that while the statute grants a lengthy list of powers, such as the power to investigate, block, or nullify, there is absolutely no mention of tariffs or duties in that section. The government attempted to argue that the power to regulate importation encompasses the power to tax. The opinion dismantled this, stating regulate typically means to fix, establish, or adjust by rules, and is not synonymous with taxation. Furthermore, reading regulate to mean tax would render IEEPA partly unconstitutional, because the statute also allows the president to regulate exportation. Interpreting this as taxing power would directly violate the U.S. Constitution's explicit ban on the federal government taxing exports. So the 6-3 split we get in this, right? We have the concurrence and a dissent. 6 justices agreed that IEEPA does not support the tariff. They don't agree on why, right? The proper interpretive framework. Now we have a concurrence from Justice Gorsuch with Justice Barrett going along with this one. And they vigorously defended the use of the major questions doctrine. They viewed it as not as a novel invention, but a long-standing clear statement rule essential for protecting Article 1's vesting clause from executive overreach. Right? Now, in Kagan-Jackson's concurrence, and these two are on the left end of the court, Gorsuch and Barrett are on the right end of the court, Kagan and Sotomayor and Jackson concurred in the judgment, but wholly rejected the major questions doctrine as unnecessary. Justice Kagan argued, because she penned this concurrence, that the ordinary textualism easily resolves the case. Noting if you combine the statute's verbs and objects, it results in 99 authorized actions, exactly none of which involve raising revenue. Now, there were 2 dissents. Kavanaugh had a principal dissent, and he was joined by Thomas and Alito, and he dissented by relying on historical context. He argued that tariffs are a traditional and common tool to regulate importation. He noted President Nixon used identical language to impose the tariffs in 1971, and he pointed to the 1976 Supreme Court case Federal Energy Administration versus Algonquin S&G Inc. as precedent that a statute authorized the president to adjust the imports permits monetary exactions. Fancy term for asking for money, right? Now, Justice Thomas added a separate dissent, so it's kind of like a concurring dissent, arguing that the non-delegation doctrine only protects core legislative powers affecting life, liberty, or property. Because importing is historically viewed as a privilege, he argued Congress can freely delegate the power to impose tariffs to the president. Now, again, dissents are interesting, but they don't control the law at this point. They're more interesting for potential ways you can read what's being said here, and then to see how certain cases in the future might drift regarding this, or if there's a change in the court. Now, one big problem we have is, and you're seeing it this weekend, is the unanswered question of what the heck is done about refunds. For any clients you have impacted by these tariffs, they're probably going to want to know when I'm going to get my money back. Do I get my money back? How do I file for it? The majority opinion remained conspicuously silent on whether or how the federal government must go about returning these illegally collected tariffs. Now, Justice Kavanaugh, remember, who was a dissenter, has no problem pointing out this issue that you guys dodged a major problem here. He sheds lights on this looming administrative disaster, relying on concessions made during oral arguments where this got a lot of discussion, including by some of the justices who either were involved in the majority, and including, I believe, as I recall, we had both Gorsuch and we had Barrett, who both actually got into this problem of how in the heck you're going to undo this. Isn't this a bit of a mess? And, Justice Kavanaugh points this out. He warned administrative refund process is likely to be a mess. One of the problems we have here is who do you refund it to? The real issue becoming, yes, we know who paid the tariff. The company that imports the item pays the tariff. Whoever imported it, that they write the check. But since many of them have passed some or all of that tariff along to consumers, to later consumers in higher prices, that gets us the whole question of, well, who do you give the money back to? Do you give it back to the importer? Or do you somehow try to figure out who the ultimate consumer was? And by the way, because importers are rarely able to pass along 100% of the increased cost, do we have to do some sort of crazy division? That's going to be an interesting question to get answered. It is possible that Congress could attempt to answer the question with some sort of general purpose rebate. But that suggests that we could get a bill through Congress right now, which seems to be a really more interesting question. Now, as we said, this is the problem we have here. It is a, economically crazy situation because we know that part of the tariff had been passed along to other parties, and that, who do you refund the money to? And I guarantee you, people are not going to wait before filing court cases looking for money and looking for refunds. That's already, those cases are getting ready to be filed right now. And they probably will be filed, a few of them this week. So we'll see what's there. And also, given the unprecedented size of the tariff, the Treasury may be required to pay billions of dollars. I've heard upwards of $133 billion have been collected. So that could have a significant consequence to the Treasury, not surprisingly. When you're advising affected importers, you need to prepare them for a highly complex and delayed refund process. It's going to take a while to figure this thing out. So we get our visual recap for this week, right? We basically have in this case the core constitutional clash in the learning resources case, which is executive overreach with the constitutional verdict, is how the court frames this, right? The executive overreach, I'll get the words out of there, right? It points out the unprecedented nature of the tariffs, which range from 10% to a staggering 145%. The president had justified this under IEEPA by citing national emergencies related to drug trafficking and trade deficits. And the executive's entire statutory basis rested on stretching the phrase regulate importation to include taxation. Now, the Supreme Court's verdict, which is on the right side of the screen, you're watching this on the video version, there the court held firm to the text of Article 1, Section 8, which explicitly and exclusively vests the power to lay duties and taxes in Congress. They're saying, that's it, that's as far as we need to go. They said the court's statutory finding that the power to regulate importation is entirely distinct from the power to raise revenue. The list of powers granted the president under Title 50 U.S. Code Section 1702A1B is missing any mention of tariffs or duties. Didn't say it. Also, the key issue here, at least for a large part of the majority, the court utilized the major questions doctrine to conclude that such an extraordinary delegation of Congress's taxing power would require clear, explicit congressional authorization, which IEEPA simply does not contain. Now, I would note the concurrence from the liberal justices essentially arrives at the same argument that, the language of the statute doesn't contain this issue. But they didn't suggest that, well, if we didn't have the major, we didn't have essentially the major questions doctrine, that then regulate maybe could have been read to mean tax. They're saying no, under no rational reading does regulation mean tax. That's not the plain text. A meaning of regulate does not include taxation. So the real problem we've got, how's the money coming back, and if it is? In any event, having dealt with this right now, we can move on to our next topic, which is the depreciation rules under the One Big Beautiful Bill Act, specifically the special depreciation allowance under Section 168N, which is the one related to qualified production property. And notice 2026-16, that also was issued on Friday, February 20th, deals with this issue. This provides some crucial, immediately administrative guidance regarding the new temporary special depreciation allowance for qualified production property. Because the enactment of the One Big Beautiful Bill Act fundamentally altered depreciation timelines, we needed some operational rules prior to issuance of proposed regulations and final regs. And this is meant to bridge that gap for this whole issue under 168N and how it moves forward. So the key things we're looking at here are going to be Notice 2026, I should say 16, came out on February 20th. And the key sections we're looking at here are Section 168N1A and 168N1B, right? And Section 70307 of the One Big Beautiful Bill Act modified makers in Section 168 by adding a brand new subtraction under 168N. This provision establishes a temporary 100% special depreciation allowance for qualified production property, QPP. Under 168N1A, if a taxpayer makes the proper election for eligible qualified production property, the depreciation deduction for the year the property is placed in service includes an allowance equal to exactly 100% of the adjusted basis of that property. And it's important because one of the qualifying requirements to be qualified production property is it must be, in essence, commercial real estate, which normally be a 39-year recovery period. So very advantageous, rapidly increased expensing. When you apply this new section, you must follow the strict ordering rules. IRC Section 168N1B mandates that the adjusted basis of QPP must be first reduced by this 100% deduction before computing the amount otherwise allowable as a regular depreciation deduction for that taxable year or any subsequent taxable year. You're not allowed to double up here. And pending formal regulations, this notice, 2026-16, provides the details rules governing the definitions, property eligibility, and recapture that we're going to look at over the next few slides. First, to define QPP. To qualify for the 100% special depreciation allowance, the property must be non-residential real property, that is maker's property, used by the taxpayer as an integral part of a qualified production activity. Now, Congress imposed very strict, rigid windows for eligibility. The construction of the property must begin after January 19th of 2025 and before January 1st of 2029, so by the end of 28. Additionally, the property must be placed in service after July 4th of 2025 and before the end of 2030. 168N2C explicitly excludes any portion of building used for offices, administrative services, lodging, parking, sales, research, or software development from being qualified production property. Therefore, normally we must allocate the unadjusted depreciable basis between eligible and ineligible property using a reasonable method, such as based on square footage or a cost segregation analysis. There is, however, a de minimis rule that's added by this notice. To reduce compliance burden, the IRS provided a taxpayer-friendly safe harbor. If 95% or more of the physical space or property satisfies the integral part requirement at the time it's placed in service, the taxpayer may elect to treat the entire property as QPP. So as long as we have, 5% or less, we have 5% or less of the property that is non-QPP under these automatic, having to reclassify things out, including the ones by statute and the ones that simply just aren't used in the proper type of process. If we can get that below 5%, we can just treat the entire property as qualified production property. Now, here's the other catch here. We're looking now at Section 168 N2BI and across reference Section 179 D2 and 3. There's an original use hurdle. Generally, to be qualified production property, must be property whose original use commences with the taxpayer. However, clients that produce, basically, are purchasing an existing building can utilize a specific used property safe harbor. Acquiring used property can qualify as basically acquisition of QPP if you meet 3 rigorous tests with this property. That property was not used in qualified production activity by anyone between January 1st of 2021 and May 12, 2025. Okay, the January 1st goes back a few years, so you've got to look at that. It's not just based on the day that we'd start worrying about this. So we got to look back. And remember, we're using a term here that wasn't defined back in 21. We have to go back, though, and find out what that building was used for, essentially from January 1st, 2021, all the way through May 12th of 25, or through the date that we finally took it over, and figure out if it was used for anything that would have been qualified production property during that time for qualified production use, qualified production activity, I should say. Second, it was not used by the taxpayer in question prior to the acquisition of the property. And third, it meets related party and cost basis requirements under 179 D2 and 3. Now, separately, if a taxpayer buys and capitalizes major renovations, those improvements are strictly treated as a separate unit of property. Therefore, the original use requirement will be inherently met for those newly constructed improvements if the underlying building fails used property rule. So the used property rule can get the entire, commercial building portion of what you acquired into the mix. But even if that doesn't work, you still can claim the improvements as separate property. And those improvements, if they qualify as QPP, then you'll be able to take the 100% write-off. And to satisfy the requirement that improvement like a new wing or electrical upgrade is an integral part of a QPA, you should look at the integrated facilities rules. If multiple properties operate together and are physically co-located, they may be treated as a single unit. Notice 2026-16, using example of a $2 million electrical upgrade. Its qualification as QPP is determined by whether the factory it services operates as an integral part of a QPA, qualified production activity. Next up, obviously, what's a qualified production activity? So this is section 5.029 of Notice 2026-16, and this is interpreting section 168N, 2D, N7, and IRC section 954D. Core definition for qualified production activity is that the property only qualifies as such if it is used in a qualified production activity to qualify under, to be allowed for 168 and write-offs. The statute defines this as manufacturing, production, or refining of a qualified product that results in a substantial transformation of the property. Obviously, the question is, what's a substantial transformation? The IRS defines in this notice substantial transformation as processing constituent elements or raw materials into a final, complete, distinct item that is fundamentally different from the original inputs. So illustrations. Notice 2026-16 gives clear affirmative examples. Converting wood pulp to paper qualifies. Steel rods to screws would qualify, or freshly caught tuna to canned tuna. Canned tuna, right? Get that right. Things that don't qualify, The note strictly states that grouping and packaging multiple finished goods like gift baskets or subscription boxes does not result in a substantial transformation. In a similar manner, space is dedicated purely to administrative, vendor selection, or oversight functions all fail the test. And the IRS strongly cautions all of us against using this definition of substantial transformation outside of 168N. For instance, they specifically say do not extrapolate these rules or examples to other areas of the code, and specifically call out section 954D as a place you should not attempt to use this. What about the recapture rules? And that's a special rule we've got here. So this looks at section 8.01, 1A and 1D, and 8.051, along with interpreting IRC sections 168 and 5A, newly added, and section 1245A1 and 2. You have to aggressively monitor these assets due to the 10-year trap. In essence, there is a strict 10-year looking forward monitoring period beginning on the date the QPP is placed in service. And if it doesn't maintain its qualifying property status for that entire 10-year period, you will have a 1245 recapture event. Now, if there's a change in use, a recapture event under change in use is triggered if the property ceases to satisfy the integral part requirement and is used in a disqualified productive use. Note that switching from one eligible qualified production activity to another eligible qualified production activity does not trigger recapture. Now, the mechanics, if it is determined that there has been a change in use that triggers this, then 1245 treats the property as being disposed of, forcing the taxpayer to recognize ordinary income equal to the excess of the property's recomputed basis over its adjusted basis. And the recomputed basis would be the basis that you would be at, assuming you had actually used the standard depreciation period for that property, rather than take the 100% write-off. So in essence, it's going to be much like what happens when, let's say, we have a vehicle. We have a vehicle. They took it 179 because it was over, the magic level. So we got 100% bonus. So this vehicle was entirely written off the first year because they used 100% for business use. But then, a year later, they dropped below 50%. Remember, we have to go back and recompute straight line and figure out how much they would have gotten, add back the excess they've taken over what they would have had at the beginning of the year, pick that up as recapture. Basically the same thing here. They got to recognize that ordinary income. Now, there is a temporarily idle safe harbor. That is property taken out of service for a finite period with the expectation of resuming a qualified production activity, like during a production line upgrade or facility maintenance, is considered temporarily idle and does not trigger a change in use. Obviously, we're going to have a finite period that we can point to and our reasonable expectation of resuming qualified production activity. Now, if only a portion of a massive facility undergoes a change in use, the recapture applies proportionally. So you got to determine a recomputed basis of disqualified portion using a reasonable method such as square footage. Again, nice little visual thing here to summarize this. You like pictures? We got pictures, right? In this case, it's got a summary of the mechanics, limitations, and compliance rules for the new temporary 100% bonus or special depreciation allowance under the One Big Beautiful Bill Act. Eligibility and timelines we see here on the left side. You got to look at the core requirement. The property must undergo a substantial transformation, such as converting raw wood pulp into paper. There is the critical regulatory timeline that you'll find there along the bottom, right? Construction must begin on January 19th. The property must have been placed in service before January 1st of 2031. And by the way, we're going to borrow the rules we normally use for bonus depreciation to determine beginning of construction, which means if it's self-constructed property, the 10% rule will come into play, right? Or, binding contracts also come into play for acquisitions of things. So we're looking at that. Remember the 95% de minimis rule? If we, in fact, have less than 5% of it that would not qualify to be part of the QPP, we'd have to allocate it away in theory. We can go ahead and ignore that, which is good news, right? We have the exclusions that's there. There are some ineligible property uses that are defined by the statute that we basically told it there. You can't use for offices, parking, sales, research, or software development. And you must carve those out in that realm, right? We have that. We have the 10-year recapture clause. Remember that we have that. There is a huge risk if it doesn't stay. There's no excuse here. In fact, the company just, let's say, hey, it turns out that making whatever we were making is just not going to work. So, we basically decide to convert the factory into, I don't know, a showroom or something, do something different, but we don't need that manufacturing capacity anymore. You're going to trigger the recapture. So you have to be aware of it. There's no real excuse there. And also remember, there is a required election statement. Didn't mention it much on the slides, but the notice tells you exactly how to make this election. If your client is acquiring property that may qualify under 168N for the 100% write-off, you want to make sure you carefully note, how to make this work and you follow the rules. Next up, we have Notice 2026-7, issued on February 18th. This talks about the corporate AMT and their adjustments and relief. So this is the third major development, right? We're going to look at this issue. Now, the IRS issued Notice 2026-7 on February 18th, 2026. We've already had some guidance issued on the corporate AMT, but this is additional guidance and targeted relief. And following the release of the proposed regulations, tax professionals warned that Treasury that rigid adherence to financial statement income, FSI, without adjustments were causing some severe compliance burdens and artificially accelerating it's referred to throughout this as CAMT liabilities, corporate alternate minimum tax liabilities for major corporations. So, utilizing the authority granted under Internal Revenue Code Section 56 Cap AC 15, which allows the Secretary to issue guidance preventing the omission or duplication of items, the IRS issued this notice provides specific technical adjustments to adjusted financial statement income, and they're going to cover these adjustments to repair deductions, intangible, and research amortization in the following slide. Again, if you're working with tax compliance or planning for a corporation that is subject to the corporate AMT, you need to get this notice out and read it. We're just going to kind of glance on it for today because, again, it applies to a very small number of taxpayers. While they may be big taxpayers, it's not going to be a huge percentage of the tax professionals, even of all tax professionals in this country, are not going to be working on those. So it is a specialized topic, but it is big enough I felt we had to at least discuss it here. Now, so we're going to look at the issuance of Notice 2026-7 on February the 18th. And this is going to cover IRC Section 55, IRC Section 56A, and IRC Section 59, and a subsection of IRC Section 56A, C15. Right? So this is additional and much needed interim guidance. We talked about the pushback already from the proposed regs, and we talked about the statutory authority, all of which we're going to work through here, right? Now, the first major fix we have here, which is for repair deductions and 197 amortization, addresses the treatment of repair and maintenance costs for IRC Section 168 property. Practitioners noted these costs are routinely deducted currently for regular tax purposes under Treasury Regulation 1.162-4, but are frequently capitalized and depreciated for book purposes. Now, the adjusted financial statement, right, income fix, to prevent the nightmare of maintaining separate CAMT records for each of the Apple financial statement income property, the IRS will allow AFSI to be reduced by deductible tax repairs. However, to prevent double dipping, the entity must simultaneously disregard book cost of goods sold repair depreciation. Right? Also on goodwill and intangibles, because they have similar issues that exist for them. Under 197, we generally take a rateable 15-year amortization deduction for tax, while book rules only allow recovery upon impairment or disposition of goodwill. This mismatch was creating what many argued was inappropriate corporate alternative tax liabilities in the years in which the amortization was claimed. Notice 2026-7 provides that AFSI may be reduced by deductible intangible tax amortization. Upon the eventual taxable disposition of the assets, the practitioners and taxpayer are going to have to redetermine any gain or loss in the FSI by using a newly recalculated CAMT basis rather than the standard AFS basis, okay, alternate financial statement basis, or Apple financial statement. How about research, amortization, and production costs? This looks at Internal Revenue Code sections 174, 174 Cap A, and 181. As you should be aware, the One Big Beautiful Bill Act created Section 174 Cap A, which reintroduced immediately expensing for domestic research and experimental expenditures, R&E expenditures. This inadvertently created a transition period where the regular taxable income takes into account a dual layer recovery. Current expensing under 174 Cap A and continuing amortization under prior year expenditures under Section 174. And yeah, if you're a small taxpayer, there's an option to just go back and amend as if nothing changed on domestic. But if you're not one of those, even if you're using these basically the interim rules for 1 year or 2 year write-off, we still got we're still going to still have a chunk we're expensing in at least the first year, that was capitalized in the prior years. And then we're going to go to expensing. So it's kind of a mess. Because AFSI remained unchanged during the transition, this mismatch occurs. And notice resolves this by allowing the AFSI to be reduced by the Tax Cuts and Jobs Act Domestic 174 amortization, ensuring books and tax recoveries are properly aligned. This entity must also disregard book research or other software development amortization. A parallel issue exists under Section 181 Qualified Production Costs. That allows immediately expensing of qualified film, TV, and live theatrical productions. Book accounting, however, generally is going to capitalize these costs as a single asset. The IRS provides a simplified tracking. A bifurcated AFS asset, was basically overly complex. But notice 2026-7 simplifies this by allowing AFSI to be reduced by the deductible 181 costs, as long as the entity disregards related book cost of goods sold, depreciation, and expenses in later years. Next up, we've got a couple of other reliefs, one on materials and supplies, and another for financially troubled companies. And these cover Treasury Regulation 1.1623C1IV and Treasury Reg 1.1502-28. Now, clients with a high volume of tangible property under $200 face a book tax discrepancy. These items are deducted currently for tax under Section 1.162-31IV, but are often capitalized for book, resulting in an artificially elevated AFSI. What the notice does is levels the playing field between these entities and those holding traditional 168 property by allowing the AFSI to be reduced by deductible eligible materials and supplies. That simplifies this. On bankruptcies and troubled companies. Transitioning to those entities now, the notice clarifies that the application of attribute reduction rules. The IRS specifically confirmed the consolidated return rules under Treasury Regulation 1.1502-28 apply. So, for CAMT entities emerging from a non-transactional bankruptcy utilizing fresh start accounting, there are very specific computational rules found in this notice. The CAMT basis must be computed by completely disregarding any gain or loss reflected in the FSI, as well as disregarding any adjustment to the AFI basis that resulted from the bankruptcy emergence. Finally, let's talk about anti-avoidance and outbound transfers. Practitioners were highly critical of the proposed 2-year anti-avoidance rules under proposed Reg 1.56 Cap A-4. The prior rule acted as a rather blunt instrument, forcing full AFSI inclusion if even a single dollar of foreign stock basis was taken into account within 2 years. Now, the 2026-7 provides relatively welcome relief by modifying the strict per se rules into a rebuttable presumption. Now, such a transaction is merely presumed to have a principal purpose of avoiding CAMT liability, but you can rebut that presumption. taxpayers and an advisor have a defense avenue now. You can successfully rebut this if a taxpayer can present facts and circumstances clearly establishing that the transaction had a valid principal purpose other than avoiding the corporate minimum tax. Okay? That's going to be the key issue. Finally, the notice addresses double taxation concerns related to outbound transfers of intangible property under Section 367D. And the IRS dictates a foreign corporation properly treating a deemed payment as allowable deduction may reduce its adjusted net taxable income by that amount, successfully presenting double taxation at the entity level. And again, we have our nice little picture here for some key, AFSI adjustments under this notice, right? So we have these deductions here. This is really a summary, like I said, very through these things. We have the tax repair deductions here, the special rules we discussed for goodwill and ineligible, and basically an intangible amortization, the research expense issues, and then we have the operational adjustments and anti-avoidance rules, which for specialized production and supplies issues, our rebuttable anti-avoidance presumption we discussed, and the treatment of bankrupt and troubled companies. Next up, an appeal to the circuit, a petition for a writ of certiorari in the case of Murrin versus Commissioner. This was a case decided by the Third Circuit Court of Appeals in 2025. And on February 17th, the petition for the writ of certiorari was filed, right? So they want the U.S. Supreme Court to dive into this case, which we discussed a few months ago, you may remember. And this case asks where an innocent taxpayer can be subject to IRS assessments decades after filing simply because their third-party preparer committed fraud without the taxpayer's knowledge. The outcome of this case dictates whether taxpayers can rely on the statute of limitation, basically to take this away from you after a certain period of time, or if they're going to face a regime of being potentially liable for any return you ever had done prepared by somebody, a tax preparer, if that preparer can be shown to have prepared a fraudulent return. Because remember, a lot of preparers are out there selling, we get you the biggest refund possible. And obviously, one way to get a big refund is to lie. That is one way to it. Not saying they all do that, but it is a method some unscrupulous preparers have definitely taken over the years. So let's talk about the main dispute here in this case. A foundational rule of tax administration is found in, IRC section 6501A. I accidentally touched the button and flipped the slide. So sorry about that for those who are watching on the TV or on video, your computer, whatever. So section 6501A generally says the IRS has to assess tax within 3 years of the time you filed a return. Right? So that means we get to the third year. So, we're sitting here, somebody filed on time, the return on time for 2022. We get to April 15th of 26. The statute will have closed because 3 years will have gone from the deemed date it was filed in April of 2023. If they're on extension, we go to the actual date they filed and look at 3 years from that. But, it's all over. So right now, for most of us, the IRS cannot go back and assess tax on a 2021 return issue. That return is done, gone. We don't have to keep records forever and be able to defend that return forever. IRS has lost their chance to challenge it, unless it turns out that this is covered by the exception at 6501C1, which allows the IRS to assess at any time, so no statute, in the case of a false or fraudulent return with the intent to evade tax. Now, the key question in this case is, does this indefinite tolling of the statute of limitations apply when the fraud and intent to evade belonged to a third-party preparer and the IRS is unable to show the evidence, because the burden's going to be on them in this case, that the taxpayer had intent to defraud? Right. In Murrin, the taxpayer hired preparer Dwayne Howell for years 1993 for 1999. Howell, the preparer, placed false entries on the returns to evade tax. He was eventually convicted criminally of, basically doing these returns to evade tax. The taxpayer signed them in complete good faith, entirely unaware of the fraud, or at least the IRS couldn't prove. that Stephanie Mirren was aware there was a fraudulent item there, and they're not even asserting that that was true. But despite her innocence, the IRS assessed a notice of deficiency in 2019, over 20 years past the standard assessment statute expiration date. Right? They had 3 years to assess, and they're talking about assessing for returns in the 90s from 93 to 99. They're issuing notice of deficiency in 2019, which is its own question about why the IRS was still there doing it, but that's a whole different issue that was never covered in a Third Circuit decision. So we're now going to go back and look at the Third Circuit's decision in Mirren versus Commissioner. And the citation for this is 158 F. 4th, page 527, a Third Circuit case 2025. And they're going to reference the Barton Werfer versus Buckley case, which is U.S. Supreme Court case 598 U.S. page 69, 2023, as well as look at IRC section 6501C1, IRC section 6663C, and IRC section 6664C1. The Third Circuit ends up with an agnostic intent of the statute. The Third Circuit affirmed the tax court decision, ruling the IRS could assess taxes for returns filed between 1993 and 1999. They held that IRC section C1 is agnostic regarding who possessed the intent to evade. If the return was prepared, is fraudulent on its face, and there was intent to evade by anybody, not just the taxpayer, right? Because let's face it, the preparer had intent to have the taxpayer evade taxes, because that increased the refund, which probably arguably increased the number of returns they got and the money they'd make. That would be the issue. Now, the panel relied heavily on a textualist analysis of the passive voice used in the statute. Citing Supreme Court's bankruptcy decision in Barton Werfer versus Buckley, the Third Circuit reasoned that the phrase false or fraudulent return focuses on the event, the filing, rather than the actor, the taxpayer. The court further justified its stance by pointing out that unlike the civil fraud penalty statute of 6663C, right, or the reasonable cause exception of 6064C1, subsection 6501C1 deliberately omits the word taxpayer. They're saying, see, that's the proper way textually to read this. Now, one thing I'm discovering, every decision now claims it's being textualist. And the theory of textualism was that, well, this is going to make it easy. You follow the plain meaning. However, we're quickly discovering that judges disagree on plain meaning. We'll see how this one goes, right? Now, the Third Circuit explicitly stated it was parting ways with the Federal Circuit, creating a direct circuit split with the 2015 decision BASR partnership versus the United States. Now, to be fair, Third Circuit, what they really said was that because that intervening Supreme Court case, that effectively BASR holding had been overturned. The Federal Circuit has never said that, and the Supreme Court's never ruled on it. But that's the Third Circuit's view. Now, in BASR, dealing with a fraudulent tax shelter promoted by an attorney to innocent partners, the Federal Circuit held that 6501C1 suspends the statute of limitation only when the taxpayer themselves act with a fraudulent intent to evade tax. The Federal Circuit emphasized the exception must be read, in essence, along with other fraud provisions found in the code, such as sections 7454A and 6663, which specifically evaluate and penalize taxpayer conduct. And there's also historical context. The BASR court in the Federal Circuit, the panel, traced the statutory language back to the Revenue Act of 1918, knowing that historically the fraud penalty and limitation exceptions were housed in the same section, intrinsically linking the suspension of repose to the taxpayer's specific intent. Suspension of repose is a fancy way of saying the statute of limitation, right? You had to have intent for this to happen. Now, the arguments for the Supreme Court to review this. A key one is the argument against the geography of justice. The petition argues that the current split creates intolerable disparity. And this is because how you get the Federal Circuit is you have to go to the U.S. Federal Court of Claims, right? To get there, you must prepay your deficiency and sue for a refund in the Court of Federal Claims, right? And then you're protected by the BASR standard. Now, the problem is, of course, most taxpayers don't want to pay the tax to start. Many can't pay the tax to start, right? And also, even if you can, it is generally more expensive to have to go to, to try a case in either U.S. District Court or the Court of Federal Claims, right? It's going to be a more expensive process, if nothing else, because in the case of Court of Federal Claims and in the case of Federal Circuit, you got to argue the case back in D.C. There's going to take some issues here, right? Poorer taxpayers are going to really have to use the tax court, and they're going to get the Murin standard if they live in the Third Circuit, essentially tying the meaning of federal statute to a taxpayer's net worth, right? Murin, and obviously we'll see if the tax court seems to believe that, in essence, BASR has been overridden, whether or not, or it never was correct anyway, because there's no real way for a tax court case to get to Federal Circuit, as I recall, jurisdiction issues here. You go to tax court, you're going to lose, right? They're going to allow the IRS to go forward. The only way to get around the IRS going forward right now and know for sure it's going to happen is to pay the tax and go to the Federal Circuit. Finally, a petition attacks the Third Circuit's textualist logic. It argues that because the tax being evaded is a taxpayer's tax, the return is a taxpayer's return, and therefore the intent to evade tax must naturally belong to the taxpayer. Like I say, because the Supreme Court now clearly has tried to throw into the textualist, entirely into textualist interpretation, for everything, and textualists, I think even critics of textualist interpretation, are going to say it definitely has a key place. The problem is it's not a golden bullet. And I think that's probably, to me, has been the case too, looking at what's happened just recently. It's not like this suddenly eliminated different judges having different views of what the same text means. And we're looking at that here. Now, this does have some implications for us in our practices, right? Under 6501C1, right? The circuit split carries severe repercussions to us. Because we have to be aware that a client's prior association with a fraudulent preparer promoter could reopen closed years indefinitely if the client was completely innocent and a victim of that professional. The standard advice to retain records for 3 to 7 years is going to be highly insufficient if the IRS alleges third-party fraud and goes back 30 years. They did that to Murin. People are going to tell me they never go back that far. Stephanie Murin chooses to object to your statement. Stephanie says, oh, yeah, they did. They have the right to do it. That's what I always tell people. It's very important to know in tax, what does the IRS in tax practice? What does the IRS normally do? They normally don't go back 30 years. But separate from that, what do they legally have the right to do? Because you're going to find out in most tax matters, the fact they haven't done something before is not going to be considered a valid reason why the taxpayer shouldn't have to pay tax, if the law itself clearly says, the IRS is right. So what they can do is go after every open year. We have to understand that. So in assuming a new client, you probably should inquire about the history of preparers they've used in prior years. And if they utilize, have you ever utilized a preparer that you later discovered was, prosecuted by the IRS? Of something of that sort. And you find out that this person was, thrown in jail, etc., found to be fraudulent. There's a risk here. Now, the problem is, I don't know how to deal with that risk easily, aside from having the client, get legal counsel, right, and try to get legal counsel to see if the IRS be willing to negotiate a formal and complete settlement. But that's going to cost a lot of money. And like most CPAs and EAs would say, the IRS doesn't go back 30 years normally. So it's not a good answer, but it is a problem and a flag that clients have to understand. As it stands right now, the service could go back that far. And we know they did once. That's a key issue. So essentially, if the Supreme Court leaves the split unresolved, they don't take it, then effectively, the IRS is going to have the right to assess tax, and certainly that's the tax court, to follow the Murin case. And since the tax court was started out with Murin and ruled in the IRS's favor, we expect they're going to follow Murin. You really have that problem if the service going back 30 years and alleging that the preparer committed fraud. Because you've got to defend the preparer. Not, in order to defend your client, and in order for the client's counsel, essentially, because this would probably end up, it's one of these things where with the numbers, because what really hurt Stephanie is not the tax, it was interest and penalties running for 30 years. That got really expensive very fast. Remember, interest compounds daily. That's really important to understand, right? So, make clients aware of this problem. Make clients aware this is a huge risk of hiring somebody who may be pushing the envelope too far. It's not enough, and it's going to hurt a client, to be totally blunt, if the reason you went to this guy because he promised the biggest refund. Well, obviously and hoping you don't get caught could produce the biggest refund. I suppose to be like taking an Uber driver because they swear they could drive me from Phoenix to Tucson, faster than anybody else. Well, yeah, if they floor the thing, they can they can do it by violating every law. If they don't get caught, we're okay. We don't get an accident, we're okay. But there are issues here, right? But there can be a case of innocent taxpayers being done. So we have our nice little recap again. We have on the left side, you have essentially, we're going to look at the Third Circuit's agnostic view in the left center, saying all that matters is the return itself is fraudulent. We don't care, right? The Federal Circuit says no. Under this provision, the taxpayer must be the one who had fraudulent intent. If the taxpayer didn't have fraudulent intent, then the standard 3-year statute and not the infinite statute apply. And of course, the taxpayers are complaining that, in this case, Murin, that because she couldn't afford to pay the tax and sue in the Federal Circuit, where she would have gotten a refund, the argument is, if they don't, unless they reverse BSR, but it's highly likely she would have gotten a refund. That's an unfair. That is a nature of the current federal court system and the nature of the fact that the tax court's a national court. We have these quirky problems. But yeah, remember, unless the Supreme Court has ruled on something, generally, you're bound by your circuit, and circuits can disagree on key issues of law. In this case, the Federal Circuit and the Third Circuit certainly appear to disagree on this one. And that's where we have a problem of where do you go. Now, the good news about the Federal Circuit is everybody can get there. The bad news is you got to prepay the tax. But let's say if the Ninth Circuit says no, they'll go with the Federal Circuit and say, no, it's got to be the taxpayers. The taxpayer has to be the one with fraudulent intent. Well, then, now somebody living in Phoenix is protected, but somebody living in, let's say, Princeton, New Jersey is not under this rule. Next up, we're going to take a look at our fifth and final development of this week. And it's the tax court issued a highly instructive memorandum decision in North Donald LA Property LLC versus Commissioner. If you represent partnerships, this was a syndicated conservation easement case. Sounds familiar, right? Had a lot of these. And this is essential rigorous guidance. The court provides an evaluation of qualified appraisals, taking a look at highest and best use claims, and applying IRC Section 709 to syndication costs. This is somewhat new. We hadn't seen syndication costs before. And also navigated civil fraud and gross valuation misstatement penalties. So let's talk about this. And this is going to sound familiar to the earlier transaction we've seen. The transaction here involves the Donald Farm, which was a 3,324-acre property in Louisiana, historically used for farming rice, soybeans, and crawfish. The soil contained heavy clay, which was great for retaining water for crawfish, but there was no commercial market for the clay in the area to sell it. Now, a promoter known as 60 West purchased the property in March 2016's arm's length transaction for just under $9,900,000, which equated to just under $3,000 per acre. Now, 60 West carved out a 260.48 acre parcel to syndicate to the petitioner, which is the North Donald, Louisiana Property LLC. Despite this property being zoned agricultural, the partnership's appraisal posited that the highest and best use of the land was a commercial clay mine. Well, it's not Georgia, so we can't do granite, so we're going to do clay this time. If this sounds awfully familiar, it is. This we're on repeat. And the bad news is that the taxpayers keep, in essence, these partnerships that have been sold as tax shelters keep, going to the tax court. The results aren't changing. Somebody's got to get a win in the Court of Appeals if this is going to change. Because the tax court, gang, let's get it through our heads right now. You're going to lose it, right? If you've got these facts. What are the facts? They utilize a discounted cash flow method for this land now based on this theoretical commercial clay mine. Remember, tax court does not like this. The tax court has told us in published decisions that highest and best use is not appropriate for raw land that has never been used for such a use and for which there is no demonstrable likelihood that it would be used for that at any time in the foreseeable future. Right? But they use that to claim, remember, it's $3,000 an acre? We're now going to get a value of $439,492 per acre for this, the before issue. So on 2017 Form 1065, the partnership claimed an $11,391,000 charitable contribution deduction for the contribution of an easement. Remember, they paid less than $10 million for this property. And they're claiming $115,309,000 for giving away only the easement, right? So the position was the land had appreciated by more than 14,000% in just 21 months on its stated basis of $802,232. And like I said, that $10 million was for all of this big property. This is just a small part of it. Yeah, gang, that's a tough to believe story. First thing, ignoring everything else, that sounds way too good to be true unless you have, to be totally blunt, I need a sale of property nearby to that did have somebody buy it, for, in this case, $800,000 and then sell it for over nearly $120 million, right? Because it's only partial. If you can't show me a real one that happened, this thing is just not going to fly. And I'm telling clients, it's not going to fly. The only chance is nobody audits it. And these days, if the number of these cases we're seeing, guess what? These things are getting audited. This one's happening. So, a couple of issues here. The challenge on whether there was a qualified appraisal and whether that appraisal was done properly and whether highest and best use is an appropriate way to do it. Now, the IRS argued the appraisal failed to follow the standards here of the U.S. PAP standards, the ones normally used in appraisals, right? Now, the court reiterated the technical failure to follow the standards does not make an appraisal per se non-qualified. It merely affects its persuasiveness. Because the tax matters partner lacked knowledge of the promoter's deceptive letters of intent, right? The promoter had made up letters of intent that suggested that there really was a claim mine that could be done in there. The appraisal technically qualified, preventing complete disallowance on strict substantiation grounds. But it was given zero weight because the court did not like highest and best use method that was used here. Establishing a property's highest and best use requires proposed use be legally permissible, financially feasible, and have a reasonable prospect of achievement. None of which was true about this supposed clay mine, right? The court forcefully rejected the clay mine's highest and best use. The land was zoned exclusively agricultural. Rezoning was unlikely due to intense neighborhood opposition against a 100-foot deep pit with heavy truck traffic in their agricultural areas. Even if rezoned, the mine was not financially feasible because of distance to levee projects that would use the clay and exorbitant wetland mitigation costs would be required to mitigate the damage to surrounding wetlands. This thing would never be a claim mine. No chance whatsoever. But again, what happens in these cases is they hire an appraiser to just basically brainstorm some wild theory about something, whatever's on the property. Well, it's something that is mined some places and where it's in the perfect place next to the perfect location where there's no mitigation costs. It would be worth this. None of those are true about this property. The court's not accepting theoretical highest and best uses. You need to show actual ability. If zoning would block it right away, you've got to show that you can or it will be rezoned. And you got to show that there's really somebody out there looking to do it. You can't just build this theory out of nothing. Okay? So the court threw out the computation based on discounted cash flow, right? This royalty income method is wholly untethered from reality, is the term the court used, which is not a good term for the court to be using about your evidence. The court found the best evidence of fair market value was the comparable sales approach, right? In an arm's length transaction, reasonably close in time to the valuation date. And guess what? We always have one of those because they bought this just 21 months earlier, right? So that March 2016 acquisition becomes a comparable sale and sets the before value. That's the problem. You just created. If there's no other sale, why I say I want to see somebody else sell property at this kind of appreciation, I need a comparable sale. And if I don't have any comparable sale, the purchase, the partnership's own purchase of this property, or the promoter that spun out into a partnership purchase of the property, is going to be your comparable sale, which is a disaster for these. Okay. Now, the partnership also claimed in this case, so after determining, I say, this post-easement value, the court concluded the reduction attributable to the easement was only $675 per acre, yielding a total allowable deduction of $175,000, somewhat down from $115 million plus. Yeah. Now, the partnership also tried to claim over $1,150,000 in other deductions as investment expenses, including a $1 million plus counseling fee and a $50,000 legal fee for a tax opinion letter. Now, the court said these are IRC Section 709A syndication costs, right? They're strictly non-deductible organization and syndication selling expenses, and you can't just bury them as other deductions. So, and that is a very basic rule in partnership taxation, which kind of tells you in many ways that, yeah, we're not spending a lot of time on these shelters, maybe, getting all the little things right. Because honestly, compared to the deduction, for the conservation easement, this is utterly irrelevant, right? There's no need to claim this deduction. So the only reasoning for it is just being way too greedy or just not knowing you can't do this. And if you don't know, that's a real problem if you're buying your tax shelters from people that don't know things like this. So we got a couple of options for how to get on there. None of them are good. However, civil fraud, that did a little bit better on in this case. In addition to disallowing deduction, the IRS asserted a 75% civil fraud penalty under Section 6663. Now, the IRS has a heavy burden to do this. Under Parks versus Commissioner, to carry 75% civil fraud, the IRS must prove by clear and convincing evidence, not just preponderance, but clear and convincing evidence, right, that there was conduct. The taxpayer intended to evade taxes by conduct specifically intended to conceal, mislead, or otherwise prevent the collection of taxes. The taxpayer's ultimate saving grace from the fraud penalty was their rigorous disclosure. I have told people disclosure is your friend. In this case, it's a bad result for other reasons. We'll get to the gross valuation penalty here and gross valuation misstatement problem. But they at least got rid of the 75% addition to the tax, which is more than the 40%. So at least we got rid of this. They attached a Form 8283 and a Form 8886 for reportable transactions that explicitly showed the massive disparity. A cost base of $800,000 and a claim value of $115,391. The court placed great weight on those disclosures, ruling that such a massive disclosed gap between base and value would raise an immediate red flag that essentially invites an audit. The court said, when taxpayers return and it says in effect, please audit me, the commissioner has an uphill battle to prove intent to conceal. Now, I got news for you. In many cases, the IRS doesn't read the please audit me section. Right? They ignore 8275s and things like that all the time. They just don't jump at those. But if it's there, the IRS has a tough time defending why they didn't read it. I know I called out, a couple of weeks back, I believe it was, called out a situation, where, preparers sometimes get in trouble because they didn't read the instructions, and instructions can create a return that's considered not filed if you don't follow them. Well, IRS not reading the return is the equivalent of the preparer not reading the instructions. You were told this, you didn't pay attention to it. It wasn't hidden from you. It was the court was clear. This was obvious. These forms are the forms you're supposed to put on. These forms are supposed to be disclosing this stuff. This is right where the IRS wanted it to be. In fact, they chose not to read it. Tough luck. That prevented the 75% fraud penalty. We didn't go any further than that. Okay? But couldn't get out of, which has been true in every one of these, the 40% gross valuation misstatement penalty. Right? Under 6662H, a misstatement is defined as gross if the claim value exceeds 200% of the correct amount. Yeah, this was way over double, right? 115 million, which a value that was only under 200,000. Well in excess of 200%. Bingo. Remember, as we tell you every time here, there is no reasonable cause defense. There is for the standard substantial evaluation misstatement, 150%, you can show reasonable cause. But once you get to 200%, it's just simply mechanical. The claim value on the return is more than twice what the court determined the value should be. You're just going, 40% penalty is automatic. There is not an out. You can't claim you relied on a tax professional. You can't claim you relied on the appraiser. It doesn't matter. Your excuse simply doesn't matter here. There's no reasonable cause. You're there. And finally, the court imposed a 20% negative penalty under 6662B, one on the portion of underpayment related to the disallowed $1.15 million in other deductions, the syndication and organization costs, right? And they tried to argue they relied on their professional advisor, but the court ruled they failed to establish good faith reliance on professional advice for deducting what the code says is clearly capital items. Had they seriously, right, actually ask a competent advisor whether these could be deducted, are these deductions correct? Yeah. And there's no proof they ever actually raised the issue. Merely just, having somebody prepare the return does not generally get you this good faith reliance. So 14,000% delusion. That is a record. We've talked about a lot of these. I don't recall anyone being anywhere near this number, right? So what we have is, the fantasy versus reality, right? So we had a fantasy that somehow this was worth 14,000% more than we paid for it, that those idiots that sold us to it just utterly didn't understand the mining. My theory is, why didn't we sell it? We were idiots. Why are we giving away and making sure it can never be done? Either we got a huge charitable intent, which seems not likely, or we don't really believe the value. We believe it's not even worth what we're going to get for the charitable contribution. So we're going to take that, right, at least on an after-tax basis. The court's finding was that agricultural was what was going to always be done. It's what it was sold for. It's what people were selling the lands for there. There was no comparable sale, anything like what they showed. And it was highly unlikely to see, anything changed in this, right? The bottom tells us why highest and best use fell apart, right? Under the White House Hotel, a valid highest and best use must be legally permissible, physically possible, and financially feasible. The claim mining theory failed on all the fronts. The land was zoned agricultural, was 90% wetlands, and rezoning was highly improbable due to the community opposition. As well, market saturation and high transportation costs made the proposed mine economically impossible. And of course, our big problem is the 40% gross misstatement penalty is what you always get hammered with in these cases. Be aware of that, right? Again, if the claimed value is more than twice, they need to get to that level for the tax benefits to pay for the investment, right? Because they have their investment plus the fees they're taking. For your tax rate, even at the top rate, they're going to need to probably have at least a 200% increase, if not far more. In this case, way more. Yep, another problematic conservation easement case. This brings us to the conclusion of this week's current federal tax developments for February 23rd. To recap, today we looked at the Supreme Court's major invalidation of executive tariffs under the IEEPA, the IRS's interim guidance for the 168N 100% deduction on what's basically commercial real property if it's used for a qualified production activity. Right? We need that. We're going to look at the CAMT adjustments also the IRS issued this week, if that involves you. The hoped-for Supreme Court showdown over third-party preparer fraud. Stephanie Miron hopes they take up her petition. And just yet another crazy, insane, and it's not going to work, syndicated conservation easement case. At least not going to work at tax court. Gang, you got to get these to the Court of Appeals and win. I don't hold out a lot of hope you're going to win at the Court of Appeals, but I really hold no hope you're winning at tax court unless you've got some substantially different facts. And no, just having it appreciate 10 times more than anybody else is not the direction I'm looking for significantly different facts, to be honest. So, if you have any questions, you've got my email address, edzollars@currentfederaltaxdevelopments.com, which is on the slides. You can download the slides and the text of the updates from our website, currentfederaltaxdevelopments.com, on the audio and video updates page that you can see there. I also I'm a member of a number of state societies, look at their Connect boards. That includes, I follow the Connect postings on Arizona's board, New Jersey's, Illinois, Minnesota, and Washington, and Idaho. So keep that. If you have any questions that you post there, and I think I can help answer, I'll try to jump in. But otherwise, thank you for tuning in this week. And it's been yet another fun week of current federal tax developments. And hopefully we will see you again next week.